Morning to all and welcome back again to today's Daily Dose of Market Insights. Very good morning. I'm Kelvin here. Today will be the Wednesday, the 17th of September 2025 and also FOMC Day. So before we kickstart the gist of today's Daily Dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessary indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so today will be a full suit of the daily dose of market insights, which I will cover all the intraday technical outlook on those broad-based cross-asset classes, a total of 12 instruments in all. So before we do that, let's have a quick recap what has taken shape yesterday in terms of the intraday movement of these broad-based cross-asset classes, ranging from the major US dollar pair, the six major stock indices, and as well as the two key commodities market, which is gold XAU/USD and West Texas crude oil, relevant to their respective news flow and key economic data release. So yesterday, big move was in the FX market. So still recall that in my daily dose ever since about 3 to 4 weeks ago, we do mention that do keep a lookout for this potential pronounced US dollar weakness. And very interestingly, ahead of today key risk event, the which is the FOMC meeting. So later I'll touch more about the FOMC meeting, that we start to see further weakening of the US dollar, where the US dollar actually broke below the key major support of 97.3. So yesterday we do have a couple of interesting news data, or I would say economic data, that support this view over here. So what I could see, one of the data that is actually supporting this dollar weakness view ahead of the Fed, because we know that the Fed, a lot of market participants right now are anticipating a Fed dovish pivot. All right, so yesterday we have a release of this Eurozone ZEW Economic Sentiment Index. So that's taken as that's a business sentiment index for Eurozone. So yesterday that sentiment index from Eurozone came in better than expectation. So over here, let me share with you where's the index. All right, where is it? Pardon me, somewhere up here. Yeah, correct. This is the index. All right, let me expand it. All right. So this Economic Sentiment Index came in way better than expected. So market is expecting a decline from last month number of 25.1. So that was the August month. So this forward-looking month of September, it came in at 26.1, way above market expecting, and also slightly above August print of 25.1. So if you look at the trend of the ZEW Economic Sentiment Index in Eurozone, it has slowly starts to improve. So you look at the 10-year trend, it slowly starts to print a series of higher low over here. So indicating business sentiment has starts to improve marginally in Eurozone. So that also support the Euro strength that is being seen in the US against the US dollar yesterday, where the euro actually hit a 4-year high. So later I'll touch more about the intraday technical outlook on the euro dollar. What are the key levels to look up for? So bear in mind over here is that the key thing is that the US dollar index yesterday plunges, all right, over here. So this steep plunge yesterday, it broke down below negative 0.71%, negative 0.7, negative 0.71%. So this is the steepest daily loss on the US dollar index since 1st of August last month over here. And bear in mind, this 97.3 is very, very important. So 97.3 is the monthly chart, is the long-term ascending channel support that was that I drew from the low of May 2011. So by breaking down below this 97.3, because we know that this is a very long-term chart, monthly chart. So if we could have a weekly close followed by a monthly close below this 97.3, it could increase or cement the high chance that the US dollar is in the motion of evolving into a multi-month major bearish downtrend phase. All right, so that could potentially also lead to positive feedback look into other risk asset classes, not including into US, especially in other region where potentially we may not start to see a kind of a longer term or medium term outperformance of especially Asia Pacific stock indices versus the US. We talk about outperformance, relative performance. Okay, so now another data I will share with you guys, or event that I will share with you guys yesterday, is more pertaining to this ongoing US trade relationship that US and China has. We still have been on a very frosty ground. So yesterday, US President Trump, he did mention that he will extend the deadline for the TikTok deal as both sides continues to ink out more details about that framework that has been agreed on 2 days ago, 2 days ago, where there is this agreement that Biden's will actually shift their operations and business, we call it ownership of TikTok US into US corporations. That means taking away this TikTok, we call it US business operation wholly owned by the US corporation away from the Chinese ByteDance, Chinese ByteDance corporation. So they call it diversify the platform in US operation. So this divestment right now is they have agreed to that, but details has yet to wake up. Details has yet to be finalized. So yesterday, President Trump signed an executive order to extend the deadline of this TikTok Chinese parent ByteDance Limited to to actually sell away the platform, the US platform operation until 16th of December. So giving more room for negotiation. So do not forget, Trump also did mention that this particular ByteDance slash TikTok deal with US corporation is actually part of the package that the US and China is dealing with on the trade front. All right, because they're now doing that trade negotiation to iron out differences while extending the trade tariffs deadline until November this year. All right, so going forward also that Trump also will speak with Chinese presidency on Friday to discuss about this potential deal as well. So this actually also causes a positive feedback loop into the China and slash Hong Kong stock market today. So if you look at the Hang Seng index, it's usually up by 1.25%, and also the Hang Seng Tech Index is up by 3%, and the mainland A shares benchmark stock index, which is the CSI 300, that comprises of both Shanghai and Shenzhen stocks, up by 0.3%. And also another primary positive factor that is driving this current bullish momentum in the China slash Hong Kong stock market is for sure will be a weaker US dollar. Secondly, we also have another, which is this China US trade relation. Right now, there's some potential, we call it at the end of the day, there could be some kind of light at the end of the tunnel, given that yesterday Trump extended that TikTok deal, TikTok deadline, we call it divestment plans further to allow more room for negotiation, to allow more room for finalizing of that details framework. And also the most important one is yesterday during the evening Asia session, the China top policymakers come up with more measures to stimulate the consumption slash services sector in the Chinese economy. So what do I mean by this? So yesterday, there's this issuance of this new plan to assist consumption, but this time around not really on consumers, but on services. All right, because we know in the last 3 to 4 months, the Chinese top policymakers has been advocating about this trade back policy, where consumers bring back their old electronic appliance to actually kind of exchange for a newer gadget or something like that. But this time around, they decided to actually do much further by services such as sports and entertainment over here. All right, so this actually also there's actually 19 measures to actually develop infrastructure and guide banks. So right now is that they actually allow banks to be more, I would say that generous to lend more to these services providers and consumers as well. So basically, right now, the authorities in China, or the top policymaker in China, is now trying to actually shift their focus away from heavily emphasizing on the hard tech sector of the Chinese economy. That means, i.e., previously they pour in a lot of resources in AI, robotics, biotechnology. Now they're actually shifting to the softer side of the economy, which is more pertaining to the services slash consumption. So that actually also created a positive feedback loop into the stock market in China and Hong Kong. All right, so then back to other things to look out for. Yesterday was a profit-taking day in the US stock market. So what I could see is that in the US stock market yesterday, we see lackluster movement. Initially at the start of the US session, there's a push up where the SPX and the Nasdaq 100 do a intraday all-time high again, but cannot maintain that momentum and see profit-taking throughout the entire US session yesterday. So it did actually sell off dramatically, but that is just more like a whipsaw intraday movement. So the SPX is down by 0.13%. The Nasdaq is down by, it's almost unchanged, negative 0.08%. The underperformer is the Dow Jones Industrial Average, down by negative 0.3%, and almost unchanged on the Russell 2000 as well. The small caps, negative 0.09%. So basically, very interesting data I'll share with you on the US Wall Street 30 CFD index, which represents the Dow Jones Industrial Average. It's now resting at a key short-term pivotal support level, all right, ahead of today's FOMC meeting. Okay, so right now, back to FOMC meeting. So given the fact today's will be a key event all centered on FOMC meeting over here, so that could potentially create a lot of intraday volatility among different asset classes. For sure, gold will be impacted as well, because gold has been rallying very strongly in the last 1.5 weeks or so after that bullish breakout above 3,500. That's gold XAU/USD. So the reason why gold has been going up so high is because of the highly anticipated Fed dovish pivot. All right. So Fed dovish pivot, it means that Fed will start to kickstart its interest rate cut cycle, eventually create a so-called positive feedback loop into gold, given that gold is a non-interest income bearing asset. That means if interest rate goes down in the US, gold quoted in US dollar will face less opportunity costs. So that actually indirectly could actually create higher demand for gold. So if you look at gold price over here, is that yesterday there's also a bit of hesitation by the bulls over here. So what I could see that yesterday, we call it doji spinning top candlestick pattern at only rally up by 0.3% after that very steep push up since 1st of September, which is starting the start of this month earlier on. So later I'll touch on what are the key levels to watch on gold. All right. So now center onto the FOMC meeting. So FOMC meeting over here is that if you look at the CME Fed Watch 2, right, everyone is now expecting the Fed to cut by 25 basis points as being portrayed by the Fed Funds futures market, based on the trading behavior of the Fed Funds futures trader, compiled by this CME Fed Watch 2 over here. So this CME Fed Watch 2 over here, let's go to the 17th of September, which is today's FOMC meeting. 100% the market is looking at 25 basis point cut. Okay, why I say 100%? Because it's being split between 25 and 50. So only 4% people looking for 50 basis point cut over here. So very high chance that the Fed will at least cut by 25 basis point over here. So given the fact that that also has been guided by Fed Chair dovish speech in the Jackson Hole Symposium in late August as well, where he changed his tonality to skew towards the dovish side of the camp, where he actually mentioned that he's pretty much concerned about the softness in the US labor market. And indeed, the last few months, 2 months of NFP data has really indicate that the labor market in US has deteriorated, and this risk outweighs the inflation risk, where inflation trend in US continue to be sticky above the long-term desired Fed inflation target rate of 2%. So right now, the only thing that the Fed can disappoint is that they don't cut, but that could actually put their credibility on the stance. So very unlikely they will not cut this time round. They will actually do a 25 basis point cut. That's really big into the market. But will they do more by 50 basis points? So that is only a very small chance of 4%, as indicated by market participants in the Fed funds futures market. If, to my own opinion, they also may not be, they very unlikely they will do a 50 basis point cut, because that would indicate that the US economy is not doing very, very well. That means the US economy is on the brink of a recession, and they will do a 50 basis point cut over here. So given that the US economy is not falling off the cliff yet, a 50 basis point cut will create a negative feedback loop into the stock market. That means that could potentially see a significant short-term sell-off in the US stock market if they portray a 50 basis point cut due to an implied impending recession that is potentially that may come into the US economy if they were to actually do that 50 basis point cut. So now participants now will be very concerned about how the Fed will guide the market next year. All right, so this year we only have 2 more meetings left, which is on the 29th of October 2025 and the 10th of December 2025. So this also has been assigned a high probability that the Fed funds futures traders, that the Fed will do another 25 basis point cut subsequently in the next 2 meetings to bring the Fed funds rate down to 3.75%/4% and end the year at 3.5% to 3.75%. So that is potentially 3 interest rate cut that has been baked into the market. All right. So now, what's interesting over here is that going forward next year, the Fed funds future traders has penciled in 3 or 4 cuts. Okay, so how do I see it? Is by reading the boxes that is highlighted in the turquoise blue that shows a high chance of probability. So what I could see over here is that on the first meeting on 28th of January 2026, 70% chance that the Fed funds future expect to be at 3.5% to 3.75% after that potential third cut in 10th of December 2025. Then you read down the column down the row over here. 1 cut, 2 cut, followed by 3 cut over here. So 3 potential cut in 2026 to bring the Fed funds rate down to 2.75% to 3%. All right, so market participants in the Fed funds futures market for 2026 is now anticipating 3 interest rate cuts. So now, how will this anticipation change? It all boils down to the dot plot over here. So this dot plot, the Fed will release in every 3 FOMC meeting, not every meeting, every 3, means every quarterly. So the previous one was in June. Okay, so whatever I share with you right now on the screen is in June. So today will be the latest one. So market participants will be focusing on various key economic projection done by this dot plot. So this dot plot is actually we call it the median. People will look at the median forecast or projection that is being portrayed by the Fed funds, the FOMC members, okay, which is the US Federal Reserve officials. So market will be looking at real GDP, okay, growth annually. So they will come for the long run, 2026 and 2027. So market will be more shorter, focusing at 2026, 2027, and long run not so much. So 2026, 2027, in the previous meeting, the 2026 one was being downgraded in the June projection. So previously March it was projected to be 1.8. In June it projected to be 1.6. So there's 2 basis point reduction. And also in 2027, it will be projected in 1.8, similar to 1.8 over here. All right. So basically, right, what we are looking at over here is that the Fed is now inching towards a growth slowdown in the US economy in 2026. All right, so if this 2026 view is being 1.6 projection in the previous June release in the previous June FOMC meeting, where they released the last dot plot has been revised downwards to below 1.6, let's say 1.5 or 1.4, that could indicate a slowdown in the US economy, and that could actually increase more bets that the Fed may do more than 3 interest rate cut that is being portrayed by the Fed Funds future traders right now, like I shared earlier on. And also they'll be looking at the unemployment rate. So unemployment rate now has really been 4.3. So very likely this will adjust upward as well. Previously they forecasted to be at 4.5, so they may revise upward to 4.6 to 4.7. Market also pay to close eyes on the 2027 one. So previously that was actually being upgraded, the unemployment rate to revise upwards to 4.4. So from 4.3 previously. So if the 2027 has been also been revised projectedly upward as well to 4.5 to or 4.6, it indicate a rather soft US labor market. So that also will potentially see an increase in Fed funds rate cuts bets in 2026. And also looking at the core PC inflation. So core PC inflation over here is that also has been adjusted upwards previously. So for the core PC inflation, the March projection was 2.2. The June dot plot was at 2.4. And also the 2027 one was being revised slightly upwards to 2.1 as well from 2%. So market participants will be now looking at whether this number would change given the fact that there's this uncertainty regarding about that US trade tariffs. And also do not forget some of the higher number tariffs that the current White House kind of threatened against the rest of the world has now starts to come down over here. All right, so then most importantly will be the level of the Fed funds rate going forward. So this will actually tell rather how many projected cuts has been that the Fed officials anticipate going forward in 2026. So right now for sure this will all change over here, because right now it's actually way above market expecting. All right, so the Fed funds rate previously in 2025 it was at 3.9%. So now market expecting the Fed funds rate by the end of 2025 to be at 3.5%. So one more cut by much more dovish by the US Federal Reserve officials previously, given that the latest data on the softening of the US labor market and consumer confidence data as well on last Friday from the University of Michigan flash data for September. So this Fed funds rate will change as well for sure. So do keep a lookout, especially on 2026 over here. So whether this number will be in line with the market anticipated one as 2.75% to 3%. So very likely, to my own opinion, it will be revised downwards to around 3.23%. All right, 3% over here. And also in the 2027 market, will be looking at this potential level of Fed funds rate as well, whether this 3.4 will be revised downwards to actually 3% or slightly lower. Right. So if this comes into fruition, then potentially the next focus on will be on how Fed Chair during his press conference massage these numbers, not massage, give his guidance based on his verbal cues over here. So he will be quizzed by reporters about his view about the US labor market, and for sure about the inflationary trend in the US. And in the previous few meetings, he has been rather firm in his wait and see stance over here. So right now, any slight change of tone that he start to skew towards a much more dovish stance could actually increase the market view that the Fed will now be more serious to kickstart a slew of interest rate cut cycle, a new interest rate cut cycle. And also I think he will also be quizzed about whether does this be impacted by the current White House to do more. And also recently there's this Federal Reserve officials being nominated by Trump. He's right now inside the board staff. He is being kind of advocate for a third mandate by the Fed is to have a lowered long-term interest rate. So that is more like the 10-year US Treasury yield. So the reporters will likely quiz Fed Chair about this potential third mandate to have a lower long-term US Treasury rate. Is there any potential targeting of this 10-year US Treasury yield going forward? All right, so that is something that we got to take a look out for as this early morning Singapore time, 2 a.m. to 2:30 a.m. this Thursday on this FOMC key risk event. All right. So now I'll talk more about the fundamentals of the event. Now let us now jump straight into the technical outlook. All right, the intraday technical outlook. So just a very quick moment, right? Let me do a check. All right, to make sure that everything is fine. Okay, so that the screen can be seen. All right, I think it should be all right. Should be fine. Okay, let me expand my screen. Okay, let us go to the euro dollar first. Right, so let's start with the euro dollar. So the euro dollar previously on Monday, where we covered the full suite of the daily dose that covers all the intraday technical outlook, has managed to pierce up as expected and clear above the 1st of July swing high over here and its prior 52-week high as well. All right, at the 118.30 level. So right now, this will be a pullback support level to watch for in today's FOMC meeting ahead. So net overall, we start to see the RSI has starts to exit from the overbought level over here. So prior exiting from the overbought level, there is no bearish divergence over here. There's no bearish divergence. So what we could see is that price action continues to be in line with the price action of the RSI continue to be in line with the price action of the raw euro dollar. All right, so indicating that this bullish momentum trend is still intact, but there could be a risk of a minor pullback going forward as he has exited from the overbought level and has some more room to go down before hitting this parallel key support on the hourly RSI. So potentially, as we head into this highly volatile day today due to the FOMC meeting, and there could be a chance of a minor pullback over here. So minor pullback, maximum key pivotal support level to watch will be a tighten one at 117.70/117.90 very clearly. So this is a former minor swing high of 9th of September and 16th of September. If you do that Fibo retracement from this the current minor impulsive bullish up move leg after the retest of that 50-day and the 20-day moving average on 11th of September to the current intraday high over here in yesterday's US session. That also constitute with the 38% and 50%, 38.2% and 50% Fibo retracement over here. So net overall, still maintain that bullish bias on the euro dollar, but not forgetting there could be a risk of a minor pullback first. Minor pullback key pivotal support maximum level will be at 117.70/117.90. So as long as this minor pullback didn't break below 117.70, 117.90 level, we'll still maintain that bullish bias on the euro dollar. Above the next intermediate resistance will be at 118.90, 119.10, which is the 30th of July / 3rd September 2021 high. Potentially seek out the next intermediate resistance at 119.70, 1.2 figure level, which is a Fibo extension cluster level as well, and also the upper limit of this minor ascending channel that has been in place since the 1st of August 2025 low. So however, if we start to see a bearish breakdown below 117.70, then potentially today's bullish bias view will be negated to see a much more extension of this minor corrective decline to revisit two key intermediate support area as well. One will be at the 117.20, 117 figure level, which correspond with the lower limit of this minor ascending channel, followed by 116.75, which correspond to the 50-day moving average and the minor swing low of 11th of September. And also the 117.20/117 figure level also correspond with the rising 20-day moving average. Next up will be the sterling dollar. So the sterling dollar push up over here, hit the first resistance zone at 136.50, 136.80, which is the congestion area of 27th of June / 4th of July, and also a Fibo extension cluster as well. So potentially right now there could be a chance of a minor pullback. So minor pullback Also, key support level to watch will be this pivotal support zone at 135.90, 135.70, which is the former minor swing high of now September, and the lower limit of this ongoing minor ascending channel from the low of 3rd of September. So as long as this minor pullback didn't surpass below 135.90/135.70, maintain that bullish bias on the sterling dollar. Next resistance level to watch will be at 137.15, followed by 137.50, which is the upper limit of this minor ascending channel, and the one-time Fibo extension taken from the low of 3rd of September. Only a bearish breakdown below 135.70 will negate today's bullish bias view to see a much more deeper minor corrective decline sequence playing out to revisit 135 figure level and even 135.40. This is also very key short-term support level to watch for because it corresponds with the 20-day moving average and the 50-day moving average at 135 figure and 134.50. Next up will be the Aussie dollar. So the Aussie dollar continues to actually trade sideways yesterday, holding above the key pivotal support level at this 66.35, 66.20. So over here, what we could see is that it's still also holding above it's now trying to actually bounce off from this intersection point here, will be the former ascending channel, now turns into a pullback resistance. The green line over here, the green one, now turns into a former upper boundary of this ascending channel from the low of 22nd August, now turns into a pullback support, and also the lower limit of this much later steeper minor ascending channel in turquoise blue, drawn from the low of 4th of September at the lower boundary at this intersection point around 66.70. So right now it hit the first support zone at 66.80, 67 figure level. So 67 figure level is a very important level. It's a major resistance. Why previously I highlighted on the daily chart, 67 figure level is in fact the upper limit of this upper boundary of this expanding wedge that has been in place since April 2025. All right, over here. So right now the key level still remains the same on the Aussie dollar. So key support, I don't want to target to be so tight to at 66.50 over here, unless we have a clear bullish breakout above 67 figure level today, then I would tighten it to 66.50. So for now, the pivotal support still remains the same, 66.35/66.20. Still maintain that bullish bias on the Aussie dollar in anticipation for a potential bullish breakout of this 67 figure level, major resistance. A breakout above it potentially takes us up higher in first step towards 67.60, which is the upper boundary of this ongoing steepened minor ascending channel that drawn from the low of 4th of September and the 3.618 Fibo extension from the low of 2nd of September and close to the 2-time Fibo extension from the low of 22nd of August. Only a bearish breakdown below 66.20 will negate today bullish bias on the Aussie dollar to see another round of choppy minor corrective decline sequence unfolding towards the next intermediate support level at 65.80, followed by 65.55, which is also correspond to the rising 20-day moving average. So that's for the Aussie dollar. Lastly will be the dollar yen. So dollar yen, let's go to the longer term chart first, because dollar yen has been a very choppy movement in the last 3 to 4 months. So from a shorter term basis, it has been consolidating or in a sideways minor range sideways movement since the low of 24th of July. And if you stretch it out to 4 months, since 5 months since April, 22nd of April, it has been in this bearish ascending wedge range configuration. After a failure bullish breakout on the 31st of July, where it actually pop up on the 200-day moving average. Then thereafter, there's a fake breakout and it continues to trade below the 200-day key moving average since 1st of August. All right, over here. And right now, price action continues to trend downwards below the 50-day moving average. And yesterday, it did a negative 0.65% decline. And right now, it's testing very closely to a key support level or a medium-term key support level at 145.95, which is the lower limit of this bearish ascending wedge configuration. So now, back to and also the hourly RSI has already the daily RSI has starts to signal a pre-bearish signal, bearish breakdown of the 145.95, given the fact that you notice that the parallel ascending trend line that I draw on the RSI is very in sync with this ascending trend line of this bearish ascending wedge. So this is considered as a parallel ascending trend line on the daily RSI. So we know that RSI is measuring rate of change. Anything that is rate of change has a leading element based on a mathematical approach over here. So given that this leading RSI momentum indicator has started to show a bearish breakdown first, ahead of that ahead of this potential test of that 145.95 level on the dollar yen over here. So indicating that there could be a high chance that this 145.95 may not hold going forward, as the daily RSI has already give out a pre-leading bearish signal. All right, so this one I want to emphasize. All right, now back to the hourly time frame. So on the hourly time frame, what we could see over here is that price action plunges and hit our support level that we mentioned earlier, which is the 14670, 14640 level, which is the range support of this minor sideways range configuration that has been in place since July this year. So right now, our hourly RSI has really exited from the oversold level, exited. All right, so while exiting from the oversold level, there is no bullish divergence. Okay, there's no bullish divergence, so indicating that there could be a bounce going forward, but not a very steep bounce. So bounce level to watch, right, it will be this level here, yesterday's rejection level. Yesterday rejection level during the European session at 14705. But I don't want to target it to be so tight at 14705. I will use the 20-day moving average and also the minor swing high of 16th of September on Asia session over here that lead to this recent minor sell-off that's been seen yesterday, right, during the European session. So using a tightened short-term pivotal resistance down from 148.75 to 147.50, we'll still maintain that bearish bias in any bounces that could take shape in today's session on the dollar yen, given that it's now exited from the oversold level. So any bounces that remains below 147.50, we will have a bearish bias on the dollar yen. Next support level to watch for sure will be the key medium-term ascending wedge range support will be at 145.95. A breakdown below 145.95 will constitute further weakness on the dollar yen going forward from a multi-week perspective. But in first step, the next support level on the intraday basis will be 145.20 next. So what is this 145.20? It's the former minor swing high of 3rd of July over here. And if you will do the Fibo retracement of that last rejection from that key 200-day moving average on 3rd of September. Project it over here. Okay, that also constitute very closely to the one-time Fibo extension at 145.30. All right, give or take very close at the graphical 149.520. All right, so give this 145.20 is a pretty much significant level to watch on the downside over here. Only a bullish breakout above 147.50 will invalidate today's bearish bias view on the dollar yen for it to squeeze up towards the upper limit of this ascending wedge range configuration. Again, first resistance to watch after 147.50 will be 147.95. Above it, we'll see a retest of that 200-day moving average again at 148.75/148.95. All right, so that sum up all the FX market outlook for these 4 major US dollar pair on the intraday basis. Let us now focus our attention to the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 representing the Hang Seng Index managed to squeeze upwards over here. So it's now already hitting our resistance level already met at 26,740, 26,790 over here. All right, so right now what I'm going to do is I got to actually tighten my pivotal support level higher. So this will be my first support level to watch out for today. Okay, at 26,530. All right, so given that it hasn't cleared above 26,940, so which is very close to it, this will be my first support level to watch, 26,530. So key pivotal support level will be this congestion area here, former minor swing high, turns into a pullback support, managed to survive yesterday's dip as well very closely. So this will be my tightened short-term pivotal support level for the Hong Kong 33 to maintain this ongoing bullish bias, 26,275. Above 26,940, the next resistance zone will be 27,125, 27,285, which is a Fibo extension cluster level as well. Only a bearish breakdown below 26,275 will invalidate today's bullish bias acceleration view to kickstart a deeper minor corrective decline sequence, revisiting the minor swing low of 11th of September, which is last Thursday at 25,860 over here. Okay, next up will be the Japan 225, representing the Nikkei 225 over here. So the Japan 225 continues to bounce up as expected, managed to hold above this steepened minor ascending support channel, minor ascending channel support that I drew from the low of 4th of September. So I will have a tightened short-term pivotal support level for today, which is close to this minor ascending channel support, as well as very close to yesterday's minor swing low as well at 44,560. So using 44,560 to maintain my bullish bias view on the Japan 225. Next resistance level to watch, 45,460/45,625. Followed by 45,960, 46,220, which correspond to the intersection between this steepened minor ascending channel upper boundary from the low of this 4th of September, and also the medium term ascending from this minor ascending channel from the much earlier date, 1st of August intersection point as well. All right, only a bearish breakdown below 44,560 will invalidate today's bullish bias view on the Japan 225 to see a minor corrective decline sequence unfolding, targeting the next near-term support level at 44,050. Okay, if 44,050 can't hold, potentially it may slide deeper towards 43,580, which is coming very close to this rising 20-day moving average. Next up will be the Germany 30, representing the German DAX. So the Germany 30 is the weakest major stock indices in our coverage. So we have a neutrality stance in the last 1.5, about 2 weeks already. Neutral between 23,900 and 23,490. So yesterday it broke down below our neutrality range. So indicating a bearish exit from this kind of sideways range configuration. So over here, the hourly RSI has been in the oversold already, has been oversold territory after yesterday bearish breakdown. So potentially today there could be a minor bounce. So minor bounce, first resistance level to watch will be 23,490, and the key pivotal resistance level for today will be at 23,630, which is so the pullback line of this former minor ascending trend line that I drew from the low of 2nd of September. All right, and also if we do the Fibo retracement of this ongoing minor impulsive down move from the high of 15th of September all the way down to yesterday's intraday low, that also constitute to the coincide with the golden ratio of 61.8%. So flip to a bearish stance, but with the risk of bounces taking shape for today, given that the hourly RSI is at the oversold region. As long as this bounce didn't surpass above 23,630, I will have a potential bearish bias view on the Germany 30. Next near-term support level to watch will be 23,180, followed by 23,025, which is the minor swing low of 19th of June 2025. Only a price action break up above the 23,630 will invalidate today's bearish bias view to see a squeeze up towards 23,900, which is the range resistance level that has been in place since 5th of September, and also the downward sloping 20-day moving average as well. So that's for the Germany 30. Now, US major stock indices, starting with the US Wall Street 30. So US Wall Street 30, very interestingly, yesterday it did a slide, but that slide managed to survive right exactly at our pivotal support level that we highlighted previously, 45,780, 45,690, which is so the former ascending triangle range resistance now turns into a pullback support level, and also the lower limit of this minor ascending channel that I draw from the low of 1st of August 2025 low. And also the hourly RSI has managed to bounce up from the oversold level over here, so indicating that there could be a chance that we may now start to see a kind of bounce around or some kind of stabilization after this minor corrective move that has taken shape from the fresh all-time high that was made on last Friday. So no change, still maintain that bullish bias over here on the US Wall Street 30 using 45,780, 45,690 pivotal support zone to maintain this bullish bias. First resistance level to watch will be at 46,060, 46,180 for today. A bullish breakout above 46,180 potentially could increase the odds of another round of a minor bullish impulsive up move sequence meteorizing for the US Wall Street 30 towards the next intermediate resistance level at 46,365, 46,400 next, which is a Fibo extension cluster level. Only a bearish breakdown below 45,690 will invalidate today's bullish bias slash recovery view to see a deeper minor corrective decline towards the next support level at 45,425, which corresponds very closely to the 20-day moving average. If it can't hold above this level, potentially it may slide further towards this congestion area here of 3rd of September and 5th of September, acting as the next near-term support level at 45,290, 45,175. Very quickly will be the SPX. So on the SPX, it's have rallied and hit our resistance level 6620, 6630. So right now the hourly RSI doesn't look great. So the hourly RSI has broke down below a ascending trend line support level. Yesterday it broke down, retested it and shaped a lower high. All right, shaped a lower high over here. Okay, a lower high. All right, indicating that there could be a further slide forward into the SPX 500 as we head into the FOMC key risk event today. So what I could do over here is that, given that the trend is still up over here, so I would be using any potential pullback as a bullish bias over here. So first pullback level to watch will be at 6,580, maximum 6,550. So that will be my Titan short-term pivotal support level. Taken this that potentially this could be a minor wave 4. So this is minor wave 1, wave 2, wave 3, and wave 4. Okay, for this ongoing minor pullback. And this ongoing minor pullback wave 4 at 6,550 is potentially the 38. Okay, very close to the 38.2% Fibo retracement as well. So using 6,550 as my pivotal support level for today on the SPX, in any potential minor pullback, I will still maintain that bullish bias over here for any minor pullback. Then thereafter, potentially there could be a resumption of the bullish impulsive up move sequence to continue after this pullback end, to seek out the next intermediate resistance at 6,660 next, which is a Fibo extension level as well. Only a bearish breakdown below 6,550 today will see the extension of this minor pullback declining further towards the next near-term support level at 6,520. If this level doesn't hold, potentially it could slip down further towards 6,475, which is very close. 6,520 and 6,475 is in between the rising 20-day moving average, and also the 6,475 is this correspond to the minor ascending channel lower limit from the low of 23rd of May 2025. Very quickly will be the Nasdaq 100. So the Nasdaq 100 hourly RSI also very similar to the hourly RSI of the SPX, so I will not explain in much greater detail. So there could be also a risk of a minor pullback taking shape first before the bullish reversal take shape. So minor pullback support level in first step 24,140, maximum will be this pivotal support level at 24,050, which is also the potential end of that potential minor corrective wave 4. If we do the Fibo retracement, that also constitute with the 38.2% Fibo retracement. So still maintaining that bullish bias, but notwithstanding there could be a minor pullback first before the bullish reversal take shape. As long as this minor pullback maintain above 24,050, I will maintain that bullish bias. Next resistance level to watch 24,530, 24,570. Only a bearish breakdown below 24,050 will invalidate today's bullish bias view to see a deeper minor corrective pullback, exposing the next support level at 23,930, 23,755. Lastly will be the commodities asset classes. Okay, starting with that Gold XAU/USD. So for Gold XAU/USD, also managed to hit our first resistance level at 3,687. All right, previously hit this level, and now doing a kind of a sideways movement over here. So in this sideways movement over here, the hourly RSI, all right, over here there is still a parallel ascending support level right now. It's at this parallel ascending support level. All right. So, and also at this dotted line of this lower limit of this minor ascending channel as well. So, and also this congestion area over here. All right, this former congestion area here where it did that bullish breakout on this Monday. All right, over here. So this congestion area was formed on last Tuesday and last Friday, and managed to do a bullish breakout on Monday. So this will be a key short-term pullback area to watch. So I will tighten my pivotal support level to 3,644. So as long as this 3,644 short-term pivotal support holds, this gold XAU/USD will be still potentially in a bullish impulsive upmove sequence. Next two resistance level to watch will be at 3,725 followed by 3,750 with a Fibo extension cluster level. Only a bearish breakdown below 3,644 would invalidate today's bullish impulsive upmove sequence to actually flip to a minor corrective decline sequence to expose the next near-term support level at 3,620, 3,600 level, which is also a psychological level at 3,600, which is also the minor ascending channel support that I drew from the low of 22nd of August. Lastly will be the West Texas oil. So the West Texas oil yesterday pierced up above our pivotal resistance level, but right now the rally starts to pause at below the 50-day moving average, and also given that the hourly RSI starts to exit from the overbought level. So rather mixed element for West Texas oil. So I will have a neutrality stance for today on the West Texas oil, neutral between 65.30 and 64.10. Only a bearish breakdown below 64.10, which is a reintegration below the 20-day moving average, will revive the minor short-term bearish tone to expose the next support level at 62.70 and potentially even the minor range support in place since 5th of September at 61.85. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for other than the FOMC meeting for today? So for today, before the release of the FOMC meeting, we have a UK core inflation rate that is out at 2 p.m. Singapore time. So market is expecting a slight dip to 3.6% year on year from the previous month of July at 3.8. So that could potentially influence the movement a bit on the sterling dollar, the sterling crosses, and in some form the UK 100 CFD index. And also we have ECB President Lagarde speaking at 3:30 p.m. Singapore time that could potentially influence the euro dollar and the euro crosses over here. And heading into the US session before the FOMC meeting, we have Bank of Canada BOC interest rate decision at 9:45 p.m. and at 10:30 p.m. will be the BOC governor press conference. So market participants expecting a 25 basis point cut as well in Bank of Canada to bring their policy rate to 2.5%. So that could maybe not much influence the movement on the major FX crosses, only pertaining to the Canada dollar. All right. So those who have interest in the Canada dollar and the Canada dollars crosses, do take a look out at 9:45 p.m. to 10:30 p.m. Then thereafter will be the all-important 2 a.m. FOMC meeting, the release of the interest rate decision, where market has really been pricing a 25 basis point cut. And I shared with you earlier on, the key thing to look out for will be the dot plot, will be the economic projection, where Fed Funds official do their projection for inflation trend, GDP growth, unemployment rate, and most importantly, what are the levels of the Fed funds rate will be in 2026 to 2027. All right, that is at 2 a.m. And also massaging all these numbers will be the art of Fed Speak by Fed Chair press conference that could also cause short-term volatility to the global markets. So that will be at 2:30 a.m. Singapore time. And heading into the US Asia session early tomorrow at 9:30 a.m. before the start of daily dose, we have Australia employment change and employment rate that could influence the Aussie dollar and the Aussie dollar crosses. All right, so that sum up today's daily dose of market insight. A pretty long one today. Why? Because of the key risk event that is taking shape later on, which is the FOMC meeting, so that I wish to able to share more insights with you all. So with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.